Okay, well, we have Abhilash Narayan, Senior Investment Strategist, Group Wealth Management at Standard Chartered, now joining us with some thoughts on what he sees going on in the market and up ahead. Thanks very much, Abhilash. Good to have you with us here. Thank you for your time. The starting to get into the conversation is where oil is at right now, Abhilash. At least the economy, the macro guys are starting to talk about it. I've not heard very much on it from, the market folk. What's your sense? I mean, oil at 1991 is high. And the fact that it's come up some 30% in the last month and a half is quite large. What's your sense in terms of the impact on markets from here?
Yeah, absolutely. I mean, obviously, the OPEC Plus cuts that we saw last week were expected. I think what was the surprise was the duration of cuts. They extended it till December. Now, I think from our perspective, we should probably have seen the last OPEC cut, because if you look at the past OPEC oil production cut cycles, they generally involve 2 or 3 substantial cuts. And this time around, we've already seen 3 cuts. So, it seems that production cuts are behind us, and we should see a consolidation in oil prices here on. If I look at WTI, $88 per barrel has been a key resistance for that. Obviously, from an economic standpoint, for India, it does matter because it raises the likelihood of further current account deficit and is likely to pressure the rupee. But if you think about it from a global perspective, it also increases the risk of a deeper recession, because higher oil prices will mean that Fed, ECB, and other central banks will probably be forced to keep rates higher for longer, and that could mean that when the economy slows down, the risk of a deeper recession has increased at the margin.
Okay, got that. Abhilash, hi, good morning. Thanks a lot for joining in. I wanted your thoughts on several macro issues to do with the Indian, economy as well. But before that, in general, how are you feeling about the big event upon us, which is the US Fed meeting on the 19th and 20th of September? Do you think this could be perhaps the start of the end of the rate hiking cycle by the US?
Yeah, possibly. So from our perspective, we don't think the Fed will hike rates any further. Obviously, a lot depends on the US CPI data, which is scheduled to come out on Wednesday. But assuming we don't get a massive upside surprise, what we're likely to get from the Fed is a bit more hawkish tone, saying that they remain open to doing further rate hikes if it's required, but they won't hike any further, in our opinion. I think what would be crucial for markets is, the revised Fed projections around U.S. economic growth, and also the long-term neutral rate from the Fed's perspective, because there has been a lot of debate in the markets that with U.S. potentially entering structurally higher inflation, the long-term neutral estimate for Fed in terms of interest rates may be revised higher. So if that happens, markets could react negatively to that. But on the flip side, if Fed lowers its forecast or maintains its forecast for rates going forward, then that could be viewed as reducing the risk of a deep recession, and we could see equity markets globally rally based on that.
Hi, Abhilash. Good morning. I recall a couple of months ago when you joined on the show, you had made this point that you're positive on the Indian markets, but even more positive on the broader markets here in India. That's played out quite well. Given where we stand right now, would you be a little bit cautious, or would you continue to remain constructive on the Indian markets?
Well, it depends on the time horizon. So on a 1 to 3 month horizon, we see increased risks of choppy range-bound trading, and that's down to a few key reasons. So first of all, obviously, we are edging towards the all-time high for Nifty. So usually these levels act as a resistance, a technical resistance for the market to break higher. So that's one. Secondly, I think with food inflation, being elevated, with oil prices rising higher, obviously markets have pushed back the expectation of RBI rate cuts, and that could be a headwind for the market. And lastly, if we look at the foreign institutional flow, so back then, a couple of months back, I'd highlighted that we are seeing increased foreign money flowing into Indian markets. Over the past few weeks, past month, that inflows that has stopped. And that's partly because of the fact that on a relative basis, the strong rally has meant that Indian markets are back again in that expensive territory relative to some of its peers. So yeah, a bit choppy in the near term, but on the 12 to 24 month horizon, we are still positive on Indian equities. In fact, a month or so back, we did publish a structural report on why we are bullish on Indian equity and Indian economy on a 5 to 7 year horizon. So long-term positive, but we use any pullbacks as buy on dips opportunity.
Abhilash, we'll leave it there. Thank you very much for your time. Great speaking with you here on CNBC-TV18 as always. Thanks indeed.